Hello, friends. I'm Piyush Jain, and welcome to the show where today we are going to talk about oil, inflation, and equities. It's a world where, over the last many weeks, we have been seeing continuously increasing energy prices across gas prices, fuel prices. We have been seeing higher food inflation. We are actually seeing higher prices across edible oils. It travels across shipping, freight rates, road transport rates, container rates, air freight rates. So there has been considerable increase in inflationary pressures. The question now for the market participants, for the investors here is what it implies for the future outlook of the markets, equity outlooks, because again, because of inflationary pressures, interest rates have started to rise. So this actually becomes a very important question to answer. And to answer that, today we are bringing to you an exclusive conversation with our guest, Mr. Gopal Agrawal, Senior Fund Manager, HDFC Asset Management Company Limited. Mr. Agrawal is a veteran in the industry, 16 years into fund management, 2 years into equity research. Mr. Agrawal, welcome to the show.
Thank you very much.
Now, let's straight away go, sir, into what is happening with the macros of the country right now across both energy prices. Again, energy is a very important import constituent for us. And then when we look from a food aspect also, so we are facing inflation pressures on two sides. What it implies for the deficits, the twin deficits, fiscal and the current account deficit, and how actually you see its impact on the macros.
Sure. So what we are seeing from these November 2021 onward, the energy prices have started inching upward, and post we are seeing the Russia-Ukraine war. And in this scenario, what is happening that Russia and Ukraine are basically a large commodity producer, and mostly they are the large exporter. So Russia exports close to 7 million barrels per day of oil and oil products per day, and Russia and Ukraine combines together 180 million tons of coal export out of the 950 million tons of traded coal in the world. And they are very large in terms of these wheat and other edible oil exports. So we are seeing, because of this supply chain bottlenecks, and there is a fear of sanction, and this insurance non-availability for the Russian shipment, we are really seeing the first leg of prices which are shot up. And the Russian and the European authorities are trying to put an embargo on the Russian gas and oil import. So the Russian gas export has fallen dramatically from roughly 120 million 120 BCM to 42.5 today. So definitely it is leading to the insignificant increase in gas price, and similarly the oil prices where we are today. So definitely inflation is likely to remain high. And in this scenario, what happened generally, India is a net importer of oil close to a 4 million barrel per day. So definitely it leads to very high current account deficit, and also the fiscal deficit rises in terms of fertilizer subsidy and also some impact on energy subsidy. So net this situation is not very good in terms of these higher inflation, lower liquidity, and higher interest rate scenario.
Right. And then as we move forward, the next question will be what happens to the corporate earnings? What's your own assessment? Because this again also becomes a very a complex decoding, I would say, because once again, if you go into FMCG, it becomes like a top line revenue when you actually relate that to the inflation. But when you go to other sectors, that actually could become a raw material inflationary and maybe earnings a denting prospect. So how do you see overall corporate earnings prospect here?
Sure. So the good part is that India is such a diverse economy, and our market is constituents of various sectors. Our Nifty is so beautifully constructed that 49% of the Nifty earnings come from the global earnings, and 51% comes purely from the domestic earning. So what happened? At some we lose, at some we gain. So at the balance, the Nifty earning is not materially impacted negatively. I would say slightly it tilted towards positivity, because the higher inflation leads to the higher earnings, and also some kind in the brand company, it leads to the pricing power. So what I would say that Nifty earning at the balance will not be impacted by higher energy prices or higher commodity prices, but certainly what it leads to, the sectors which generate consistently higher ROE, ROC, they will be impacted because there is a margin pressure. So the commodity producing companies will be benefiting, and which are cyclical in nature, but the more general consumer facing company will be under pressure because there will be margin pressure.
Right, interesting. And if I would say from a market point of view, what's your own thinking from a FY23 perspective? Are you expecting a sort of earnings compression? And when I say earnings compression, it is only from a growth perspective versus the last year. Like how you're looking at FY23, because there are three factors which are playing here. One is the interest rates have started to go up. So again, that becomes higher cost of capital, higher cost of working capital. Second, we're already seeing, we just talked about which implies higher sort of raw material costs, higher transport costs. And the third is there is a bit of capital churn which is happening. So what's your perspective markets for FY23?
Sure. So it is generally speaking, it is very difficult to predict the market in a very short run. But what I would like to put the things in perspective. First of all, going into this crisis, in you can say going into FY CY22, the corporate balance sheet has been repaired very handsomely. The corporate debt equity ratio has fallen from 0.99 to 0.7 is to 1 by the end of Q3 FY22. So there is a significant deleveraging in the balance sheet has happened. So the tail risk from the corporate India is definitely not there. Second part is that what we are seeing, there will be a lot of investment will take place into the energy sector, whether it is a power, renewable, non-renewable, battery storage, green energy, and also we are likely to see the fallout of this war is that investment into the defense related opportunity, right? And also every country will like to have very consistent uniform supply chain, right? So there will be a lot of investment into that. And also the corporates which are particularly in commodity related sectors have benefited from higher prices. So what I would say, they are in a pink of health, but this gain has come because of price increase, not by the volume increase. So generally as a promoter, if you are seeing that the profitability has gone up by price increase, not by the volume increase, so definitely you would like this opportunity, the God given opportunity to use this to improve their efficiency, supply chain, automation of the plant and everything. So you should be ready even for any downturn in the global economy, right? So I expect a lot of investment will happen in short cycle projects, efficiency improvement, supply chain, automation and all. Similarly, on the flip side, I really see that the inflation generally hurts the lower strata of the society. So there will be some slowdown and impact on the mass consumption products actually, right? So definitely there will be like lesser volume growth, and there will be some margin pressure across some of the sectors which are primarily into mass consumption sector. So on a whole, like we may see still, until unless there is a change in government policy. Like Piyush, it is my duty to tell you very clearly, like what has happened in like steel sector, government has imposed 15% export duty. So this kind of so I will say this was happened just to cool down the inflation. So any step like that is a policy risk which can emerge in any sector, which it is very difficult for me to forecast. But if assuming there is no like windfall tax or anything, any kind of impact, no new policy changes happen, then the corporate earning is moving on a right track. The banking and financial sector has really come out from this NPA worries, especially in the corporate sector. Things have really turned very good. All core sector of the economies are doing very good, right? So there are minor issues are there in NPA, particularly into services sector and MSME and other, right? So which are not very large, which are not very large compared to the balance sheet size of the banks, the larger banks. So larger banks are well positioned, ROEs are expanding, and they have the highest ever capital adequacy ratio in their lifetime. So there are many sectors of the economy are in good health. So I would say that this market can have volatility, primarily led by the higher interest rate, which led to P multiple derating, and also some slowdown or fear of growth slowdown, recession, or whatever you can say in the Western world, which will have a direct indirect impact on many sectors of the economy. As I told you, 49% of Nifty earnings come from the global related businesses. So there will be volatility in the market, but at when I go with the broker consensus of 830 to 840 EPS for Nifty for FY23, I'm not talking about FY24. So you can imagine Indian market have on an average have traded at 18.4 times long-term averages P multiple. So you may see like there can be volatility, but this can be used as an opportunity to deploy on any major correction.
When I was hearing you carefully, the last 2-3 lines actually brings this question. The next question will be, then what is the kind of investment strategy you are following? Or in other words, how you would actually say that people who are hearing this, they should be deploying investment strategy. When I hear your last 2 lines, does it imply you should wait and whenever the market gives you opportunity, you should actually come and basically start buying, or it should be sector specific? Broadly, like what will be your piece of advice on that?
Sure. So certainly speaking, during this period where which is we had a very gala time, the earnings were rising, liquidity was in surplus, interest rates was going down, right? And so everything was working in our favor. So today, from that, all the things which were positive, now we are in a situation where liquidity and interest rates are behaving against you. Earnings, I would still say it is in balance, it is holding very well, and balance sheets have repaired. So you have 2 positives, 2 negatives. Earlier you have all positives, right? So that is why we have come to a stance of neutral stance actually. So in this, if there is any volatility because of various reasons, market is a market, so if there is any volatility caused by global local sentiment, definitely it will be used as a buying opportunity, because we have come to a neutral stance rather than a stance which is very negative or very positive.
Right. And from a fund perspective, the large cap or the mid cap or the small caps, what's your own thoughts around the selection of funds at present, or a selection of sectors at present? Are the mid cap stocks or mid cap funds right now going to face higher risk? Because as you said, the stronger and the highest brand quality actually could face higher sort of benefit from this. Like between the large caps and the mid caps, how should we differentiate here?
Sure. So very clearly at this juncture where we are in the market today, I would really say that valuation in the mid cap space is on higher side as compared to large cap and small cap. Okay, because generally this is a sector, this is a segment of the market which is between 13-14,000 crore to 46 odd thousand crore market cap band, which was favored very heavily in the last 3-4 years, and that is why this segment multiple have risen to a higher level. At this juncture, small cap is also relatively cheaper than mid cap and also large cap. So so the blend of the three will be a good opportunity, because at this point of time, Piyush, that the tail risk from the corporate India has reduced dramatically with repair of the balance sheet in the last 2 years.
Right. So should I assume that you're saying large cap funds will be better this time? for now?
I won't say. See, it depends on a very short duration. So suppose you are a very risk averse investor and you can't, handle any kind of volatility even of a 5 or 6, 10%. Then what happens? You have to be like much more, careful in investing. So for that kind of investor, large cap is really good. But what I would say that the investor which are coming for a longer horizon for investing. So as I told you at this juncture, small cap and large caps are more or less in a comfortable valuation zone as compared to the mid cap.
Right. And from a perspective of what should be the investment style of the fund, if anybody is choosing, should they look on valuation or should they look on other factors? Any piece of advice you want to give on that? And if there is any sort of name you want to take, if you want to.
So see, I would say that India is a growth market. So definitely the primary thing what we look for in a company where you are investing or the fund you are investing is a growth is a paramount. And especially if any company is able to deliver you growth more than nominal GDP growth rate of the country, then definitely they are doing better job. If they are doing it over consistently over a period of time, they are the compounder and they are the wealth creator. So and they should have some hygiene of ROE higher than the cost of capital, right, which is very important. So what I would really say, the growth is paramount factor. Only thing is that what do you pay for the growth, it has to be kept in mind. So if a company is a very much compounder consistent growth company, then you can pay a very high P multiple. But sometimes what happens, when the cycle is in your favor, sometimes the company reports very high growth and higher ROE, then the mistake what the investor does generally to give them very higher P multiple. So that really leads to disappointment over time. So in general, in my fund, I try to keep that hygiene in my stock selection. Okay. So there are certainly some mistakes which we do as a human being, but that is my duty to avoid some mistakes.
Right. And please take the name of the fund for our viewers, for the benefit for
So
viewers.
I currently run HDFC Large and Mid Cap Fund, which is having a combination of the around 37% in mid cap. I have around 10% in a small cap, and remaining is into large cap. So this is the fund, and I would really say that any investor which is looking for medium to long term investing, this kind of asset allocation which has been decided this already given by the regulator works okay very well for a medium to longer term horizon.
Right. And from the perspective of all the factors we talked since the beginning of this discussion, um, any particular sectors where you're turning very bullish because of all the current scenario and over the next 7 to 8 months of outlook? And any particular sectors where you're really turning bearish?
Sure. So I am really very positive onto the manufacturing sector in India. As I told you already, that corporate India has made good profit because of price gain rather than volume gain. So many companies would like to do a lot of projects on efficiency improvement, automation, like short cycle projects, and also a lot of investment will happen into renewable energy, non-renewable energy, also into battery storage and all. So I'm very, very bullish on the manufacturing as a theme. So I'm running very overweight on that actually. So that is where I'm very positive. And where I'm turning little cautious at this point of time is primarily the energy sector, because which is at higher energy price, definitely a lot of controls can come. So the policy risk is a major risk. So definitely I am running underweight on the sector. Similarly, like IT, I am running underweight. Whether I'm right or wrong, time will tell. But I have decided to keep underweight on IT because it's a global sector, and when the global growth comes under pressure, so you may have some impact on that.
I think let me take the liberty of asking one question, IT, because many viewers actually they would be thinking because the currency is depreciated, it might imply that some dollar gains would come for the IT stocks. And here is a very interesting piece of advice or piece of view coming from you, that you are taking an underweight stance on IT, which is definitely in contrast. If we take a look at the last cycle, we saw a lot of outsourcing sort of driven growth actually came in when the time was really tough. Are you really seeing that perhaps the deal momentum or the growth momentum would not be same like last time?
So there are a couple of factors, Piyush, that what happened, we had a very comfortable base because of work from home culture during the COVID period. So the IT sector had a tailwind of, as per various study, over 500 basis point in gross margin. So what has happened, this is some of that will go away with travel and visa and every cost. And even today we are seeing significant attrition and salary hike pressure onto the margin of IT sector. And generally speaking, this margin pressure onto the industry with the IT industry service, they are also facing significant pricing pressure actually. So in such a scenario, whether they will able to take price hike or not, that is yet to be seen actually. And if the global growth slows down, so it may have some impact on the volume growth also. So but currently speaking, I am positive on volume growth on the IT sector, but I feel that margin headwind is here to stay.
Interesting piece of advice coming from our expert. From that perspective, from the fund perspective, the HDFC Large and Mid Cap Fund, what are the risks now you're posing in the markets? Now I'm trying to basically round off everything what we've discussed. So what are the risks you're forcing in the markets for the FY23, and what kind of steps you're taking for your fund to really safeguard that?
Sure. That's a very interesting question. So as I told you, the current risk in the market are two. One is the liquidity and second is the interest rate. You know that Fed is likely to taper from June, is starting June, right? So definitely global liquidity is likely to come under pressure in a scenario when energy prices are rising. So that that event generally in the past, whenever it has been played out, was not very encouraging for emerging market. Second thing is that interest rate is rising. As we all know that RBI has already increased rate by 40 basis point, and they have already communicated in next couple of policy meet they are likely to raise it further. So as per the various study done, that rise in interest rate has a negative impact on PE multiple. So that is likely to have its impact. And also we may see some margin pressure on certain sector. So these are my risk on the market at this point of time, and how I am navigating it, that is very important. So what I am doing two things. One is that some of the filters I am keeping, that the company should able to raise capital at any point of time. That is very important. They should have more domestic oriented businesses, because the domestic Indian economy is doing well, and you know that we have all demography and other things are in our favor. So definitely we have long-term growth potential in India. So I am focusing my portfolio more on domestic related economy. Manufacturing, I am very positive where I am overweight. And but what I can tell you, I am not going into a shell where I am taking a decision as a risk averse investor, which is thinking about short term, but I am missing the big picture. I am not doing that. So there can be some volatility in performance, but I am trying my best to keep the investors' long-term interest very much in place when I choose a stock in the portfolio.
Well, excellent answer, and I think should serve really as a yardstick for the investors. Before we wrap up, one very quick question: are you still a firm believer in a double-digit earnings growth story this year, or we could be looking at a single-digit earnings growth?
So in my base case assumption, I still believe that we can do double-digit growth in FY23 because certain sectors have very good tailwind to report very strong earning momentum. The only caveat is that is some of the sector where we are expecting, earning rebound to happen are globally linked. Okay, so if there is a global growth slowdown, it can come under pressure. So assuming the scenario what it is today, we are believer that we can achieve double-digit growth. But I have to tell you the risk also.
Absolutely, that's very important. The risk is more important. As we believe again, if you're able to safeguard against your risk, then the market can definitely actually reward you more. Mr. Agrawal, that was a very rewarding discussion for our viewers and dear viewers. This is the conclusion of the show here. What we learned from Mr. Agrawal, that the markets again basically are still looking good. FY23 is a year where you should actually really be cautious. There are actually going to be opportunities. Large caps, again, the companies which are strong brands, those actually will continue to be offering a lot of opportunities there. But the most important aspect, which Mr. Agrawal has highlighted, we definitely should safeguard our portfolio and take adequate steps for that. With that, it's a wrap on this show. Hope you enjoyed this edition.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.